Welcome back to the third lecture on efficient market hypothesis and portfolio analysis module. As I told you in the previous lecture that we have divided efficient market hypothesis into three parts, and this is the second part of efficient market hypothesis in which we would be discussing about the applications of efficient market hypothesis and the real world evidences supporting efficient market hypothesis and the other aspects which is put down over here. So let us take into consideration each one of them as we proceed into the whole thing. So real world application of efficient market hypothesis, where it is already applied and where it is visible and how it can be used. Okay, so when we talk about efficient market hypothesis, there is an assumption that the market is considered to be efficient if the informations are flowing into the market at proper period of time and it is reflected in the movement of stock prices. Okay, and the best example of a reflection of this could be seen in these aspects. First one is index fund. So what is index fund? Index fund is nothing but you are trying to, it's a financially engineered product, and based on the movement of index, I can create a fund which is futures. I call it futures. It's a part of derivatives. Okay. So these index funds are nothing but it is a financially engineered product. And how is it visible in the real world? These are true reflection of how the market is behaving in an efficient manner because of the information flow. So it means to say that the information flow in the market is going to have an impact on the prices of stock, and this takes no time before it gets actually reflected. And the best instrument which reflects the change in the market behavior of investors is seen in index, and index funds are just a replication of what the sentiments is all about. Next, it can be seen in mutual funds and exchange traded funds. Okay, so normally here mutual funds or exchange traded funds are preferred by those investors who are considered to be passive, which means they keep things for a long period of time. Long term basis pay, they are holding these investments, and in the long run you will find that the return what a particular stock or portfolio is likely to give is a reflection of the information which has reached the market at different points of time. Third is market timing, when you have to make an investment and how EMH is going to help you in that particular thing. So understand the information flow which is happening. Whenever a new information is coming to the market, this is likely to have an influence on the prices. So what is the best time for you to invest could be determined based on the information flow happening actually in the market. Okay, so if suppose I keep an open mind and I know that a board meeting is likely to happen in Reliance on 30th of June, right? So automatically on 30th of June, this information is likely to be reflecting in the prices of shares. So information is there in the public domain. That information actually has an impact on the prices of stocks. And you can also say that this is the best time for you to either purchase a share or sell a share which you are having already. So if you believe it in that manner, you can take advantage of the changes in prices based on the market timings. There are various studies which has been carried out earlier, and I told you in the previous lecture that this is an extension of Bactria's work which was carried out in 1900, which talks about the randomness of the market. And later on, Pharma has himself taken up a lot of studies, even though EMH was done in 1960. 1960, he has worked on the same principle later on, and in 1965 and 1970 also he has done on the same hypothesis, and he found that an efficient market efficiency is not normally reflected in the stock prices based on the available information available. So what is that we have to understand is that when the prices are freely flowing, when the market is efficient, then the prices would adjust on its own. Sometimes you have, because this is a very open market and you have speculators taking an active role in the market. So speculators can either take the prices high, or it can also bring the price down. But this should be for a shorter period of time because the price would get adjusted in the long run based upon whatever information is available. And that is the reason why we say that this EMH is actually going to help passive investors. Okay, because they are going to hold it for a longer period of time. And another evidence which actually supports the efficient market hypothesis is, it says that the prices are random in nature. That is the random walk theory, which was actually derived from this particular study. There is randomness in the movement of price, and there is no such analytical tool or statistical tool which can predict the prices of stock in future. So this is one thing you should understand, that stock prices will incorporate all the information, but statistically or mathematically it becomes very difficult for any individual to actually predict the prices of any particular share or stock or the portfolio. Only thing what you can do is you can have a diversified portfolio so that you can take advantage of the changes in prices. If suppose one is going up, the other can come down. So it gets balanced. So that's the best thing which can happen in a stock market. How is behavioral finance having a relationship with EMH? Does it have any relation, or does it do not have any relation? So you should understand one thing, that the tendency of human beings is to go behind those things which they feel is going to benefit them. So in that sequence of activities, sometimes it happens that you actually go in for a irrational behavior. So irrational behavior means you actually believe that the prices are likely to come down because of certain reason. There is a fear in your mind, and because of this fear you may end up selling the particular stock at a lower price. Okay, so but if suppose you were to wait for a longer period of time, if suppose you were a passive investor, you would have waited for a longer period of time, and you could have minimized the losses which you might have incurred. But emotionally, if you are going and participating in the stock market, then you are likely to lose because of these reasons. Okay, so speculators are basically falling under this particular category. then you have certain thing called a herd behavior. What do you mean by a herd behavior? It means to say that if 5% are moving in this direction, then I will also move in this direction with the belief that there is something available over there. So that is a herd behavior. So in stock market, what happens is if 10 persons are uh, showing an interest to buy a particular stock, then the 11th person will also think that this particular stock is being demanded more, so let me also put my money over there. So that is the type of herd behavior. So you are following the crowd, and this can actually lead to bubbles, and in the long run you may end up in loss. Okay, then you have cognitive biasness. So cognitive biasness means the thinking process, the way you look at the market, the way you have tried to predict the market. Past your predictions might have come true because of certain reasons or the other. So this can actually lead to a situation of overconfidence, and this will affect your investment pattern and this is likely to lead you to a situation where you may actually lose your money. Okay, so always not be dependent on your past experiences. Your thinking process should be such that you are unbiased to all these informations. You collect all the information, do a study of your own, and then put your money in the market. Don't be driven by your past experiences or anything of that sort without doing any calculation. So if you're not doing it, then you may end up in a loss. So efficient market are those markets where you do not find individuals of this character being part of it. Okay, if you find persons to be there, then it's considered to be a inefficient market. Then there are many anomalies which have been challenging efficient market hypothesis, or you can call the critics of efficient market hypothesis. Sometimes the market has shown that the market is actually contradicting EMF, because the prices which of an individual stock or share is different from what you would have studied based on efficient market hypothesis, that all information will have an impact on the price of stocks. So this has been evident in certain situations, where one is called a January effect. So what is January effect? January effect says that most of the stock prices are likely to rise during the month of January. So this is seen for for some period of time, and it has been repeatedly being following the same pattern over year. So that's called a January pattern, for which no scientific evidence is available in terms of information flow or anything of that sort. So that's one case which actually contradicts efficient market hypothesis. A second is value versus growth anomaly. What do you mean by this value versus growth anomaly? It says that the value of the stock in the long run will outperform the prices of stock. Okay, so if suppose I am investing in particular stock, in the long run, it need not be a reflection of the actual prediction what you have done. So that is what you mean by value versus growth anomaly. Okay. And third is momentum. As I told you, it's something like equivalent to a herd behavior, which we have seen in the previous slide. herd behavior, which you have seen in the earlier slide, where a certain momentum is created in the market, and based on the momentum, you actually say that this is likely to happen, but that may not be the reality. The prices could be determined randomly. So that is something which you should understand, and that's also against the efficient market hypothesis. And what is the study? Market is not fully efficient at all point of time, is the takeaway from this particular aspects. What are the evidences which you have seen? So this has already been talked about, the dot-com bubble in 1999 2000. This was a period when the prices of shares was not actually reflecting the intrinsic value, and finally there was a major price correction done by the market themselves. So the market corrected on its own, so that's a bubble which was broken over here during this particular period of time, 99 2000. And the second case which you can call about is that in 2008, where you had the prices moving in the housing sector. So it was called the, I don't remember the exact name, something subprime market or something like that. So anyway, whenever I get it, I'll get back to this particular thing, and I would advise you. So in 2008, there was a crash in the market because of the crisis which happened in the banking sector. And what was the crisis? It was that the banking was providing loan to category B and C set of population. So category B and C set of population are those set of population who might have defaulted in paying loan previously. So to such individuals, you started providing loan to purchase houses. Okay, and after a particular period of time, what happened is these type of individuals actually showed their actual behavior by not repaying the loan, and because of this reason, there was a lot of financial loss which was happening, and eventually the market collapsed because of this reason. So this is again another case study which talks about market inefficiency, because sometimes it is not possible for us to always predict the prices of stock based on the assets which the company hold or based on the market requirement. So that is one more drawback which we have. We have talked about active and passive investing in the earlier case. So how do active investors actually take up the investments, and how do passive investing take place? These are two important things which you should understand. So active investors are those who take care while identifying the stocks in which they have to put their money. Okay, so what are they trying to do? They are trying to identify the mispriced stock. So let us assume the intrinsic value of a share is 100, but the share prices is at 90. So I can say that by investing in the share, I can make a profit. So I identify such shares, I put my money in it, and I actually take benefit when the prices are corrected in the long run. So mispriced stocks are identified, and then I am keeping it for a shorter period of time, taking advantage of it. Okay, because active investing is for a shorter duration. And next is the market timing. So market timing, whenever the economy is going in a lower condition, you can buy it at a low price, and whenever there is a boom, you sell it at a higher price. So you can somewhere or the other, to a certain extent, you can predict the market, even though there is EMH which says that efficient market behaves on its own. There are certain examples where you can actually predict the movement of prices in the market, and that can be reflected, and it can easily be taken care of by the speculators who would be buying the stocks at a lower price and selling it at a higher price based on the availability of stocks. So these are from the short-term investment perspective. So short-term perspective. From a long-term perspective, if you are going to look at things, these are investors who keep the shares for a longer period of time and try to take advantage, or it can be considered as wealth maximization rather than a profit maximization perspective, you can say. So they are interested in investing in index stocks. Okay. So because they believe that the market is efficient and outperforming it at regular interval is not possible. So efficient market is totally dependent on information which is available, and in the long run you cannot actually get fooled by short-term price changes. That is the meaning of it. So index investing is always considered to be better in the long run. And buy and hold strategy, again it is a long-term strategy which is there. You buy it at a shorter, lower price, keep it for a long period of time, sell it at a higher price. And the second thing is that you can also go in for diversified portfolio. You have to diversify your portfolio, only then you can make profit. So passive investors also believe in diversified portfolio. Okay. And what is the learning for investors from this particular thing? It says that passive strategy is considered to be better in comparison to active strategy if the market is considered to be efficient. So this is the meaning or outcome of the whole thing. So what is the role of information? I've been talking about information flow in the previous slides or lectures. So what is the role of information flow in market efficiency? So there can be two types of information which is flowing in the market. One is public information, the other one is private information. As I told you earlier when I was discussing semi-strong market and strong market, information which is available in the public is part of semi-strong market. Private information becomes a part of strong form of market because it incorporates all these informations together, right? So public informations, the stock prices actually adjust immediately because it's available in the public domain. Everyone will read those news articles, will read those informations, and has access, everyone has access to these information. So what will happen? The prices of the stock is adjusted immediately. Okay. Reason is that the informations are released in news. Whereas when you talk about private information in an efficient market, the private information is also reflected in the strong stock prices, but it takes an extra time in comparison to public information. So a market can be considered to be efficient only if the prices are not actually reflecting inside information or has imbibed the inside information before the actual information is uh, being attracted upon by the customers. Why this is being told is because of the demand and supply principle. Okay. Here, why demand and supply? Even if you have insider information, what is happening is that these insiders will start purchasing share. So the demand increases, automatically the market will react to it by either increase in price or the volume based on these things, which is likely to happen. And before they can actually take advantage of it, the market would have actually reacted to it. Okay. So the next important aspect which you should understand is the speed of information flow. So this plays a very vital role because the faster the information reaches the market would start behaving based on those informations. So with technological advancements, you can consider that this particular factor is actually impacting the prices of stock, and the market is becoming more efficient because of increased efficiency in technology. Uh, the reason being that the prices are actually reflecting either insider information, that is private information, or private public information, both public and private, reaches the market at the click of a button, and all this information is available to each and every one who is participating in the market, and they actually take decision based upon the information which is there. So the learning is that the market is absorbing all key informations which is available, and it has a role to play in investment decision, and the prices are reflected over there. Now we go into portfolio diversification. So portfolio diversification is nothing but, as I told you earlier, you are trying to increase the number of shares or the debt instruments or other securities which is available for you to put your money in. So instead of putting the whole money in one basket, I'm trying to put the money in different baskets. So that is what you mean by diversification. And this diversification, if you are able to do, it will spread the risk. And by means of spreading the risk, the return what you would be getting could be either higher or could be as per the expectation of what you have in your mind. And this is a very important aspect. So diversification is necessary for the market to actually behave in a manner consistent with the overall market movements. So the stock will also reflect the market movements. That's the first thing you should have. And as far as modern portfolio theory, which I have already discussed in the previous lecture, you talk about diversified portfolio, which minimizes the risk, and you get the market level return. So the both are going to talk about the same thing, where it says that you increase the number of securities in which you want to put your money, and in the long run you would be getting a return as per your expectation. And the practical implication of diversification is normally seen in mutual funds and other things. Mutual funds where actual diversification have taken, and when calculating this, we are going in for seeing the alpha value. So the alpha value of the diversified stock talks about the excess risk, excess return, which you would be getting by means of putting your money in different baskets. And it also helps in deviating from betting type of culture or anything of that sort. So it is always better to keep an open market where no gambling sort of activities actually take place, and let the market determine the prices on its own based on all the available information. So efficient market is always better. This efficient market is a place where you find a well diversified portfolio which is available, be it a mutual fund, be it an individual investor like me or you, who can divide the money, put it in different stocks, let the market determine in the long run you are trying to get benefit out of it. And overall, if you look at this particular lecture, idea behind this lecture is talking about how in the long run you can take benefit of the price movements and the technological advancements and get profit by means of investing in diversified portfolio rather than putting your money in one individual stock or anything of that sort. So put your money in different baskets, wait for a longer period of time, depend on technology to transfer information at a faster pace, and your stocks will reflect the actual value which you deserve. Thank you.